This is Brian Nyako Boydoku, representative of the Gandangbe Association Next Generation. We're very proud today to be joined by our esteemed guest, MK Bonsu, who's got a great presentation for us. And he's going to be discussing, this is actually the first of our financial literacy series, and he's going to do a masterclass on building wealth. So you guys got a lot to take in. I hope you're prepared to take some notes. It's going to be value packed. I'd first like to start by introducing our guest, MK. So MK is a seasoned financial professional. He's been in this space for over 15 years as a trust officer, both in Canada and the Cayman Islands. And throughout his career, he's helped a lot of individuals, families, and high net worth clients. So, he's helped them plan estates, navigate complex financial situations, structures with integrity and care. He's also a passionate educator, committed to empowering others with practical tools and knowledge to achieve financial freedom. He has a strong foundation both in finance and faith. He teaches stewardship principles and that align with biblical values. Works with a lot of churches, and I'd just like to welcome him, thank him for being here, gracing us with his presence. Thank you, MK.
Thank you very much, Brian. Thank you, and thank you to the Cadet Next Generation community. I really appreciate the opportunity to be able to present the masterclass, and I look forward to meeting everyone and hearing your questions. So if we can, without further delay, if we can, I can share my screen and then we can get into it. So yes, welcome to the Building Wealth Masterclass. I've been, as Brian mentioned, I would talk a little bit about myself, but the agenda on the table is the first thing is we will explore the wealth cycle. From there, I would describe 7 simple baby steps that you can use to achieve financial freedom. And this is taken from Dave Ramsey, who is an American radio host and also a Christian financial advisor. And then from there, we'll talk about some of the banking and borrowing in Canada, also discuss about credit scores. And then from there, we can discuss about life insurances. And then finally, we will discuss about how do we transfer wealth to the next generation, and also perhaps even build a generational wealth. And then we can take some questions from there. Just a little bit about me, just to add to what Brian had mentioned earlier. When I currently live in the Cayman Islands. I moved here with my family last year. Prior to that, I was an executive trust officer at Citibank. So I've been in the industry for over 15 years. And to become a trust officer, you need a designation. This designation is called the Trust and Estates Practitioner, is TEP for short. Prior to that, I went to York University. I did French and International Studies. I used to live in Montreal, so I had the opportunity to learn French when I was in Montreal. Otherwise, some of the stuff I do for fun. When I was in Canada, I climbed the CN Tower about 12 times. I used to do it on an annual basis. I did a Tough Mudder, which is like a obstacle course. Did it twice, 2014, 2016. And I did 2 half marathons. One was the Scotiabank, which is in Toronto. And the second one is the Detroit Windsor marathon, half marathon, which is the only international marathon in the world, because it's between the 2 countries, Canada and the US. There's a little bit about me. So before we start, I would like everybody to perhaps meditate or just ponder on these 2 simple questions. First one is who is the most important person to you? And once you have that answer, follow up with the second question: how do you plan on protecting them once you've passed away? So in terms of finances, how do you plan on protecting them once you've passed away? Like, what is your plan? What is your financial plan in terms of protecting your loved ones once you're no longer here? So this is what we are going to explore. And as we go through the slides, try to see how you can use some of these tools to protect your loved ones once you passed away. So the wealth cycle is just three steps. First step is wealth creation. This is when you get a job or a business. So it's just finding a way to create money, right? So it could be your first job. It could be maybe a side hustle, or you're an entrepreneur, so you have a business. So finding a way to generate money, that is the first step. It's just creating wealth. So once you start creating wealth, then you go to the second step, which is wealth preservation. So maybe after a while, you've gained some money. So now you can start investing, maybe buy some property for passive income. So the second step is basically investing the money to perhaps create basically having your money work for you while you sleep. So that's the second step. And then the third step is obviously, since we won't live forever, we have to transfer that wealth to someone. And to me, again, I've been in industry for about 15 years. I think the third step is the easiest of the three, because it only takes one or two documents and a plan, and you're basically done. So you can just, once the step three is finished, you can get it out of the way and then just focus on creating more wealth and preserving more wealth. But the thing is, most people tend to forget about the third part. They don't create a will, they don't create a power of attorney, they don't have life insurance. So when they pass away, then the loved ones are left with basically left behind to clean up. Sometimes it turns into disputes, and it can get pretty messy. So for me, I think the easiest to do is to start with the third step, or the third cycle, with the wealth transfer. I talk to a lawyer to get your wills, powers of attorney in place, and then from there you can just focus on creating wealth and preserving the wealth. So quickly, 7 steps, and these 7 steps, I'll go through them quickly. I actually used or practiced these 7 steps when I was in Canada, and since we came here to Cayman, we've also started to implement the 7 baby steps. So the 7 baby steps is very simple. The first step is to start with a small emergency fund, and then you move to the next step, which is the debt snowball. And then from there, you build your fully funded emergency fund. And then step number 4 is that you invest 15% of all your income. Any income that you receive, you invest 15% of it in the stock market, preferably the US stock market. And then step number 5 is you save for children's education. Step number 6, you try to pay off your mortgage. And then by the time you reach step number 7, you should be well off and you should be financially free, so you can just give and be a philanthropist. So here we go. Here are the 7 baby steps. So again, the first step is save $1,000 as soon as possible. So this will cover any short-term emergency funds, that emergencies that you may come across. So basically, aim to save $1,000 as soon as possible to cover unexpected costs without borrowing money. Because the thing is, when you get into an emergency, the last thing you want to do is borrow money. So if you plan on taking part in this program or baby steps, get to $1,000 as soon as possible. You can put it in a savings account, or you can put it under your pillow, but put it somewhere safe. It's not invested, so that while you're going through step number 2, if there's any minor emergencies or any emergency that may occur, you don't go and borrow money to cover the emergency. You will have the $1,000 to cover the emergency. And in North America, I think statistics shows that I think 50% of Americans don't have $500 to cover a quick emergency. So having that $1,000 can make a big difference. So from there, you move on to step number 2. So step number 2 is really important. So it's pay off all your debt except for your mortgage. So this includes student loans as well. So the first thing you want to do is to escape the the debt 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 trap by tackling smaller debt first. So basically, you want to list all your debt from smallest to largest. And then you're going to use what is called the debt snowball method to build momentum. So you're going to list all your debt from smallest to largest. And it's not, you don't list them by interest rates, you list them by the amount. So the smallest to the highest. So this will help you build momentum as you pay off the smallest loans or debt first. It will help you build momentum to tackle the larger ones later. So it's always important to avoid payday loans because they're just high interest products. It's not recommended at all. So basically, the debt snowball, when you are in the debt snowball, you have to stop all savings. So you stop saving money and your focus is to simply pay off all your debt. So you stop saving money, you cover your main expenses, which is shelter, food, and maybe utilities. So you basically be living on the bare minimum. So you pay all your essentials first, and then from there, any extra money that is left, you basically tackle all your debt, highest to lowest. So again, as I mentioned that when I was in Canada, I did this program. So I started it when in 20, if I recall, in 2012. And at the time, the only debt that I have was my student loan, which was about 19,000. And after learning about this program, I was able to pay off the 19,000 in 6 months. So again, I was just living on the bare minimum. I had $1,000 as an emergency fund, and then everything that I made at the time I was working at TD, and in the department that I was in, I could do overtime. So I was able to do a lot of overtime. So I used all of the extra funds and I threw it all at the debt. So within 6 months, I was able to pay off the 19,000. So that's the step number 2. Let me just take a break and see if there's any questions in the chat. Okay, no questions. Okay. So then we move on to step number 3. So after you finish paying off all your debt without, again, excluding the mortgage, we go to the step number 3, which is to build a fully funded emergency fund. So this will depend on you. The fully funded emergency fund is usually between 3 to 6 months. So you need 3 to 6 months of living expenses. So let's say if you look at your household and every month you need perhaps 5,000, you live on 5,000. So you do 5 times 3 or 5,000 times 3. So that's 15,000. If you feel comfortable with a 3-month emergency fund, then do 3 months. If you feel comfortable with 6 months, then you would do 5,000 times 6, which is 30,000. So once step 1 is completed, step 1 gives you $1,000. And then once you finish paying off all your debt, then you move to step number 3. So then you start off with $1,000 because remember, step 1, you had $1,000. So if your emergency fund is 30,000, now you need 29,000. So then here you just save as much as you can, fastest as possible to get to the 30,000. And then once you get to the 30,000, now you have a fully funded emergency fund, and then you can move on to step number 4. Oh, so there's a Bible quote here in Ecclesiastes 11 verse 2. It says, invest in 7 ventures, yes, in 8. You do not know what disasters may come upon the land. So even the Bible says, to have multiple income. So if one job or one venture is not enough, we have to try and multiply our income to generate more money. So something to think about. So step number 4 is when basically you have a fully funded emergency fund, you have no debt except for your mortgage. And step number 4 is fairly simple. This is where any income that comes in, you pay yourself first before you pay your bills. And the recommended amount is 15%. So you pay 15% out of your income, and you don't just put put it in a savings account or a checking account. You put it in an investment account. Now, again, preferably the US market, or you can also buy a Canadian market, that's fine. But as long as it's invested in a mutual fund or index funds, and basically you invest 15% of your income in an index fund or mutual fund until you retire. Now, in Canada, you can have the National Bank and Wealthsimple, they offer free investment accounts. So there are no commissions when you purchase these index funds. I think some of the major banks, you have to pay commissions on every index fund or mutual fund that you purchase. But I know with National Bank and with Wealthsimple, they offer commission-free investment accounts. So that's step number 4. Again, 15% of your income invested in the stock market, preferably index funds or mutual funds. So here, let's take a little break and let's explore compound interest, which is considered to be the 8th world wonder. So basically, compound interest works when you invest early and when you stay consistent. Now, you can start again with index funds or mutual funds, again, based on the US market. And it is really important to embrace dollar cost averaging because the stock market goes up and down. If you stay consistent with your monthly or annual contributions, this is what's called dollar cost averaging. So you buy when the stock market is high, you buy when it's low. So at the end of the day, it averages out. So start usually is recommended that if you're starting to invest in the stock market, it's always recommended to start by buying the entire stock market, which is index funds or mutual funds. It's not highly recommended to buy individual stocks when you start. So always start with index funds or mutual funds. When you become more educated and seasoned as a seasoned investor, then you can purchase individual stocks. And it's always important to plan and execute, and also to use a compound interest calculator. Now, I'll share quickly, just give some examples of how compound interest work. Can everybody see the calculator? Hello? Can someone? Oh, okay, yes, okay. So let's say you have a newborn, right? And you want to gift her something or gift the child something when the child turns 65, when the child retires. So let's say the child is born today, you don't have any money, so you don't put anything, there's no initial investment. But you know that the stock market on average returns 10% every year. So then you decide, okay, you know what, every year I'm going to gift my child $100, and I'll put the $100 in an index fund that is invested in the US stock market. So by the time the child turns 65, she will have 600,000. So basically, this is you as the parent investing $100 on the child's birthday. Just $100 on the child's birthday every year for 65 years. By the time she turns 65, she will have $600. Now, let's say, so the child is born and you say, you know what, I will start an initial investment with $1,000. And then every year from there, I will add an additional $100 on the child's birthday. So let's see how much that would be. So when she turns 65, the child will have 1.2 million. Simple as that. Now, this is for parents. Some of our parents, unfortunately, they didn't do this for us, so we are doing the 9 to 5 instead. Now, let's say you are a 20-year-old student, and you want to invest to secure your future. Now, let's say, okay, you open an account with $1,000. It's the stock market returns 10%. And so you're 20 years old. It takes you about 45 years to get to 65. And let's say you can contribute on a monthly basis $100 for the rest of your life. So if you do that, you still get 1.1 million. Now let's say you're 40 years old and you start doing the same plan. So if you're 40, you're 25 years away from retirement. So that will give you a lot less because again, you started a lot later than someone who started in their 20s, right? So we see the big difference. Someone that started in their 20s gets 1.1 million, whereas someone that started in their 40s, because they only have 21 years of investing, they only get 144,000, which is still not bad, but I mean, everybody would choose 1.1 million over 144,000. So that's the power of compound interest, right? So the earlier you start, the better. So again, this is again a 20-year-old who has 45 years of investing, just starts with $1,000, and then they invest $100 every month. Again, if we go back to the parent who is investing for their child, so if you're a parent and you want to invest for your child, you start with an initial investment of $1,000, and every year on her birthday, on the child's birthday, you add an additional $100. By the time the child turns 65, the child will have 1.2 million. So that's a little bit about compound interest. We can go back to the presentation. So I hope that helps clarify how compound interest works, and also the importance of starting early. So if, for example, if maybe you may have missed, maybe you're advanced in age, but it's not too late for your children, right? For example, if let's say your child is born and you don't have any money, so you said, you know what, every year, or let's say your child is 20 years old, you can still do the same program, right? Because if she's 20 years old, she's 45 years away. What you can do is, um, even if you invest at $100 per year, let's see how much that would be. That's 83, but that's only if you invest $100 per year, which is pretty bad. But let's say your daughter is 20 years old. Now, let me just do this properly. So let's say you don't invest anything on an annual basis, but you invest 7,500 one time, and you tell her not to touch it until she turns 65. So she still gets the 600,000, right? Because the thing is, if your child is born, right, and you invest the $1,000 and you add $100 every year for 65 years. So $100 per year times 65, that is 6,500. So at the end of the day, you're basically contributing 7,500, right? So when your child is born, you can just put 7,500 in the bank account for her, and then don't add anything, and she will practically get even more, because so she will get 4.8 million if you put the money, the lump sum, the 7,500 when she is born, and leave it in the stock market for 65 years without touching it, without even adding. You don't even have to add anything to it, right? So that's 7,500. Your daughter or your son, your child is born today, and you just add 7,500, and you don't have to touch it. You tell your daughter or your son to that's for their retirement gift, and basically they will get 4.8 million. And again, the S&P 500 historically the returns are 10% per year. 10% per year. So, I mean, you can just Google it. So this is S&P, the S&P 500 index is basically the top 500 companies in the US. So basically, when you buy something like the Schwab S&P 500 index fund, you're basically buying the top 500 companies in the US. So if you're starting to invest, it is best to just buy an index fund. And again, for example, this year, it has returned 16.89%. Last year, returned 14%. 5 years ago, 92%. 10 years ago, if you had invested 10 years ago, you would have returned, this is 220%. So on average, the S&P returns 10% per year. So if you, again, you can play with the interest, compound interest calculator, just to see how your investments will pan out. Again, the average interest return for the S&P 500 is usually 10%. Okay, hope that helps. Again, I can't see the chat, so if someone has the question in the chat, just you can open your email.
Great points, MK. Also, too, I think it's good to understand that a lot of times, as consumers in North America, we're buying a lot of the products that the S&P 500, the companies, own these products that we purchase.
Yes.
So they're out there buying Nikes and buying a lot of these material things, which is not good or bad. It's always good to, own shares in Apple rather than just buying the phone.
Yes, correct. That's very true. And again, some of these 500 companies, they include, all the products you use on a day-to-day basis: Microsoft, Apple, Google, Nike. So yes, instead of again, on her birthday, instead of buying her an iPad, perhaps buy the S&P. And again, the one that I showed, the Schwab, it's only $15 per stock, right? Sorry, $17.66 per stock. So it's not even that much. So we just have to think and plan accordingly, so that we can build a better future for our children. Hope that helps. And then from there, so that leads to step number 5, college fund. This is where you would start investing early and build a strong education fund for your child. And again, with college funds, and in Canada, we have these registered educational savings plans, RESPs. Government supports it, so it's usually highly recommended that once your child is born, you open one of these accounts and start contributing early. And again, always invested in the US market, the index funds, so that you can get a higher return when she turns 18 or when she's ready to go to college or university. So that's step number 5. You basically build educational fund for your children. And then step number 6 is simply pay off your mortgage as soon as possible. And because once you pay off your mortgage, you don't have any debt, then you'll be technically, all your income will come straight to you, except for, regular utilities. Now, one thing I would like to highlight here is that anytime you plan on purchasing a property, this formula works anywhere you are in the world, is to use this particular formula. So this formula is the 20-33 property rule. So basically, you put 20% down, 20% down payment, and that represents the 20. The 30 is that the shelter cost should be less than 30% of your household cost. So let's say your mortgage payments, your insurance, all of the cost of the shelter to maintain the shelter has to be less than 30% of your household income. And the 3 is that the shelter price has to be less than 3 times your gross household income. So if your gross household income is 100,000, then you do 100,000 times 3. So that means you can only afford a property that is 100,000 or less. Sorry, 300,000 or less. Okay, so that's basically the property formula to purchase a property. And then number 7, if you reach step number 7, technically you don't have any more mortgage, you have no debt, you're invested in the stock market, you should be financially free, you should be able to give generously, and again become a philanthropist, and then build legacy and build generational wealth from there. Any questions regarding the 7 steps, 7 baby steps? Okay. All right. No questions yet. Okay. So I'm still sharing the screen. Okay. Okay. So in Canada, in terms of banking, we have different types of banking accounts. We have checking accounts. Checking accounts are used for daily transactions such as paying bills, groceries. Savings accounts are they help store money and also earn interest over time. But we all know savings accounts, they provide very minimal interest. We also have some have hybrid accounts as a combination of both checking and savings. I mean, in Canada, I don't have to mention it, but some of the biggest banks, RBC, TD, Scotiabank, BMO, CIBC, those are the main banks. Also, we have savings options that include EQ Bank, Tangerine, Simply Financial. These usually offer free banking. They don't charge monthly fees. So some tips is use checking accounts for spending and savings accounts for financial goals. I mean, this shouldn't be news to anybody. This is fairly simple news or simple day-to-day banking. Joint accounts versus single accounts. Single accounts are managed by one person with full control and privacy, whereas joint account is usually between 2 or more that have access. I mean, this gives you way to budget together. And single accounts usually place sole responsibility on the account holder, whereas joint accounts requires trust and shared liability among the users. Usually joint accounts are ideal for couples or family that are budgeting together. So in Canada, we also have a registered account and non-registered accounts. So a registered account simply means that it's registered with the government. So when you open a registered account, it means that the government knows that you have this particular registered account and they know how much is in there. So that's what it means by registered. Registered accounts, the common ones are TFSA, RRSP, RESP, and the fairly new one, FHSA. Now, non-registered accounts are basically like the checking account and the savings account. So registered accounts are often, they offer tax sheltered growth. For example, if you have an RSP, you can contribute to it tax-free. So the thing is, when you retire and you withdraw from your RSP, that's when it's taxed. TFSA is tax-free. However, there is a limit on how much you can contribute to it per year. And basically, non-registered accounts have no tax shelter, but they allow flexible contributions. And regular savings or investment accounts are examples of non-registered accounts. So again, savings account, checking accounts, non-registered investment accounts are also examples of non-registered accounts. So if you're starting out new, if you're a student or a newcomer to Canada, it's usually highly recommended to start with a TFSA because it's tax-free. And if you plan on investing and you haven't contributed to your TFSA, it's highly recommended to open a TFSA investment account and start investing there because there wouldn't be any taxes on the interest that you gain or the capital growth that you gain. So from there, we can also, let's discuss about some of the borrowing in Canada. So Canada, we have credit cards, which offer revolving credit for everyday purchases and emergencies. We also have personal loans, which provide a fixed payment for large expenses or debt consolidation. Lines of credit, they allow flexible borrowing with interest on the used amount only. Auto loans, which I don't recommend, but everybody's circumstances is different. Student loans, which is sometimes considered as good debt because you need education, right, to further career growth and things like that. So student loan is sometimes considered as a good debt, same as mortgages. And I mean, mortgages, unless you have money to pay off to buy the home outright, most people don't. So mortgages is also considered good debt. And also in Canada, we have the home equity lines of credit, where you borrow against the equity of your home, and it's at lower cost. We also have RSP loans, which help maximize retirement savings with also potential tax benefits. So this is where, for example, let's say it's tax season, and your tax accountant tells you that if you contribute a certain amount to your RSPs, you will get a large return. Now, let's say you don't have the money, you can always go to the bank and ask for an RSP loan. So you get a loan, you invest the loan into your RSP, you get a tax refund, and then you use the refund to pay off the loan. So that's the strategy with the RRSP loans. There's also business loans, but those may require plans or collateral to start or grow a business. Always compare interest rates, repayment terms, and fees before borrowing. Also understand how your credit score can affect a loan approval and interest, and budget repayments carefully to avoid falling into debt traps. But if you follow the baby steps, you shouldn't be borrowing. You should be debt free. Decide between secure and unsecured loans based on your risk tolerance. And sometimes it's also good to seek financial counseling from banks, credit unions, and sometimes the YMCA or community. They have programs to help with financial counseling. So in Canada, we have the credit score system. So what is the credit score? So a credit score is a 3-digit number ranking from 300 to 900, showing your credit management. It's used by banks, landlords, employers, and insurance to assess your trustworthiness. And in Canada, there are two main bureaus, the Equifax and also TransUnion. Usually, if you have a credit score of 700 plus, it's considered good. 750 is amazing. Now, for example, how I built my credit score, and mine is pretty high. I guess in the 800. What I did was I would anytime I made a purchase, and nowadays all the banks, they have apps. Like, let's say I buy gas. Like, after I finish, I would use my credit card to pay for the gas. And as soon as I finish paying, I will use the app, and then I will just pay it right away on my phone. So that's how I build my credit score to over 800. So anytime I would, the thing is, in Canada, like, because of the house prices are too expensive. So nobody goes out and purchases a house, well, unless you're really wealthy. But the average person doesn't go out and just, pay cash for a house. So you need to build your credit, especially if you're a newcomer in Canada. You need to build your credit, right? Or even if you're a student, you need to build your credit. So, I started off with the credit card that was $1,000. And what I would do is I would just, whatever I would purchase, gas or food, whatever it may be. And then as soon as I pay for it, I'll pay it on my credit card. And then I will log into the app and then pay it off right away. I don't even wait until the statement comes in the mail. I would just pay it the same day. So that's how I build my credit score to what it is. And also, and also paying off my student loan, that also really helped. So how is this credit score calculated? So this is based on payment history for accounts, and that is that accounts for 35%. 30% is from credit utility, credit utilization, and then 15% is from the length of credit history, and also 10% is from the mix. So you need a little bit of credit cards, lines of credit, maybe student loans. That also helps build your credit. And what impacts your credit is new inquiries. Let's say you want a new phone, and Bell or Rogers, they have to run your credit score. That kind of it impacts your credit score. So anytime there's a new inquiry, that reduces your credit score. I don't know why that makes. I don't know the logic behind that, but apparently, yeah. Anytime there's a new inquiry, your credit score decreases. Any questions regarding credit scores? Okay, no.
Yeah, I got a question for a credit score.
Yes, go ahead.
A lot of times you hear strategies about, let's say, a family, siblings or spouses. One gets a credit card, they put the other person on the credit card, and that helps build their credit as well. Is that true?
Yeah, that's true, but that's something I've never really done. Again, when it comes to debt or credit, yes, okay, yes, that is true. If you like, for example, if a parent add their child to their not okay, well, not child as in like under 18, but let's say a parent add their 18-year-old child to their credit card. Yes, that would work as a what do you call it, additional holder. That would work. Yes. But again, at the end of the day, I mean, if the parents does bad, then it affects the child as well. So yes, that works.
Thank you.
Yes. Okay. So how do you go ahead?
Sorry, can I please touch on that?
Yes.
Okay, yeah. So essentially, that's called like an authorized user.
Yes.
And so, like, when I was trying to build my credit score, I had a friend who added me as an authorized user on his credit card, but his utilization was under 10%. And so that it could benefit you or it could harm you
Yeah.
depending on the credit history
Correct.
of the account that they're authorizing you as a user on.
Hmm.
That's all.
Yeah. So I mean, I wouldn't recommend like having a friend again. Like I said, maybe a parent or maybe spouses. But the thing is, you have to know the other person's history, right? If you don't know the other person's history, then you're basically taking a risk. But yeah, but I mean, I wouldn't recommend. But again, everybody's situation is different, so it has to be looked at on an individual basis. That's a really good inquiry. Okay. So how do you build your credit score? So basically get a secure credit card to start building credit safely. Pay all your bills on time, including phone bills and internet services. Keep the credit card balances under 30% of the credit limit. Avoid applying for credit card too frequently to maintain a good score. And also, this is really important. Check your credit report annually to spot any errors. Also, to spot if there is um, fraud, right? If there is a transaction you don't recognize, things like that, or somebody had applied for a credit card that you know you are not aware of. Usually, it's recommended every time you do your taxes. So around tax time, it's a good time to remind yourself to check your full credit report. And nowadays, there's a lot of apps that you can use: Credit Karma, Borrow Well. Even the banks now, if you have the apps, the banks, I think they offer credit scores and credit reports inside your app. I think TD has one, BMO has one. I'm not familiar with the other banks, but TD has one, BMO has one. Okay, there. Yes, local credit tools. Yeah, Borrowwell, Credit Karma Canada, Equifax Canada, TransUnion. So yes, you can get your credit reports from these merchants or entities free. Again, always start early and stay consistent. Yeah. So from there, we can move on to insurance. So when we talk about insurance, we are focusing here. We are focusing on life insurance, not car insurance or liability insurance. So basically, life insurance pays a tax-free lump sum to loved ones once you've transitioned or passed away. So it helps covers funeral expenses and outstanding debt. and provide income replacement for your family. A lot of people don't think about this, but this is one of the most important things. It provides income replacement for your family that you left behind. It can also support funding for children's education, and also it assists in estate planning for smooth wealth transfer. So what this means is, for example, if you have an RSP, right? So an RSP, when you pass away, 50% of an RSP is taxable. So let's say you have an RSP of 100,000 and you pass away, 50% of it is taxable. Let's say you don't have any other money. So the government will have to, you have to pay the 50,000 to the government. So if you have life insurance, you can use the funds from life insurance to cover the 50,000, right? So that is one thing that also life insurance can do as well. And also life insurance is a key part of building generational wealth.
Sorry, can you say that again about the using the insurance?
So life insurance is a key part of building generational wealth.
Well, no, but before that, you mentioned that if you have money in your RSPs, you get taxed.
Oh,
You take it out at retirement.
yes. So
Have life insurance. What?
yeah. So basically, if you have an RSP, right? So let's say you have an RSP and you have your spouse or your children as the beneficiaries of your RSP. So I'm going to give simple examples. So let's say you have 100,000 in your RSP, right? 50%. So sorry, you have 100,000 in your RSP. The beneficiaries are, let's say, your son. When you pass away, since your son is named as the beneficiary of the RSP, the bank will release the 100,000 to your son. Now, the Canadian government will say, okay, well, we need our 50%.
Because it's at the highest tax bracket.
Yes, correct. Because when you die, everything is deemed to be considered disposed. So,
Right.
which means everything is considered to be sold, right?
Yeah.
So, therefore, you have to pay taxes. And, if it's at the highest marginal rate, you're looking at 50%.
Right.
Right. So, let's say you don't have any other income or any other funds in your estate. So, the Canadian government was going to say, okay, well, we need our 50%.
Mm-hmm.
So, they're going to go after your beneficiaries. So, in this case, they'll go after your son. So, because since it's a registered account, they know who would receive the fund. So they'll go after him and say, hey, your father passed away, he owes us 50,000. He doesn't have any more money, so therefore we need a 50,000 from 100,000 that you receive.
Mm-hmm.
Now, if you don't have 50,000 in your bank account or in any other account, you can get a 50,000 life insurance to cover that tax liability.
So does that mean that they're going to take your life insurance, or how are you going to cover that?
Well, so your executor. So basically, this is where you need a will, or but basically your executor will have to, because before your executor can make any distributions, he has to make sure that he pays any tax liability that your estate owns to the Canadian government. So if he doesn't, then the executor will be liable as well. So if you have a good executor, he will make sure that the tax liability is covered. Yes. So is again, is really we'll get to death and things like that later on, but in Canada, death is considered basically death when you die. Death is taxable.
Yes.
Right. So basically, what it means is that you have to plan for it, because you're going to pay taxes when you die. Well, not you, but your estate.
Of course.
So if you don't plan for it, then your loved ones will have to be the one that will have to face the consequences.
Mm-hmm.
Yes. So this is a simple example, because a lot of people invest in RSPs, but they don't really foresee what could happen. Right. So if you have RSPs, you have to be conscious that at least you're looking at 50% that could be taxed.
Agreed.
And so you have to find a way to cover that tax obligation when you pass away. And again, life insurance is one of the ways you can tackle this particular challenge.
Okay.
Yeah, so I hope that helps.
Absolutely.
Okay. So let's review some of the types of life insurance we have in Canada. There are three main ones here: term life, whole life, and universal life. Personally, I have two term life insurances. I don't um, purchase whole life or universal life simply because I don't believe life insurance and investing should be mixed together. So I separate my life insurances from my investments. So the first term life insurance sorry, let me just give a little brief description of the features. So term life insurance usually has a fixed period, usually 10 years, 20 years, 30 years, 40 years. It's very affordable. There's no cash value. And this is best for young families or to protect your mortgage. In case if you have a mortgage, you pass away, you can use that life insurance to pay off the mortgage so that your loved ones can live mortgage free. Whole life insurance is for lifetime, so basically you pay for the rest of your life. It has a fixed premium and it builds a cash value. It's good for estate planning and long life coverage. So it covers you your whole life. Universal is lifetime, similar to whole life, but it has an investment portion to it. It has flexible premiums and it has an investment component and is good for wealth building and also tax planning. Now, the last one that I have here is final expenses. Usually this is where like a prepaid funerals, basically, that's what it's for. But that's usually you get those from funeral homes, but let's focus on the three first. So let's use my example. I purchased my first term life insurance when I was 28. I'm 40. Sorry, I'm 39 now. So I purchased my first term life insurance when I was 28. So it was for a 30-year coverage, and so this will expire when I turn 58. And the coverage was for half a million, 500,000. And the premium, which I'm still paying till this day, is $440 per year. So it's not per month, it's per year. So as you can see, it's fairly affordable. And also life insurance, the earlier you purchase, the better. Simply because when you're younger, you're basically healthier. There's no underlying issues, right? So I purchased mine when I was 28. So as you can see, as a young man, they did all the physical tests, blood tests, whatever, and I was pretty healthy. So my premium annually is $440 per year. So the reason why I purchased that is simply because I wanted something that was affordable, and this would give me leverage to invest more money into the stock market. Do we have oh, is there a question? Okay, yeah, go ahead, Liz.
MK, I'll wait for you to finish, then I'll ask the question.
Oh, okay, all right. Yeah. So I purchased my first life insurance at 28. So again, when I turn 58, it will expire, but the insurance company will come to me and they will ask me if I would like to renew. So at that particular age, I can say yes or I can say no. Now, since my premiums are fairly low and I'm investing in the stock market, my initial plan is that by the time I turn 58 is to have enough invested in the stock market to reach $500,000. So that is my initial plan. So if when I turn 58, I have $500,000 invested in the stock market and my insurance expires and the insurance company comes to me and say, Marfo or MK, do you want to renew? I can say yes or I can say no, depending on my life circumstances. But if I don't renew, then the money that I paid, the $440 per year, which comes to a total of about $13,000, that basically goes to waste. Now the thing is, if within the 30 years I pass away, then my family will receive the $500,000. So basically, I'm using a life insurance as a leverage to build the $500,000 coverage. So hopefully by the time I turn 58, I will have $500,000 saved in the stock market. That's my plan. So that's a little bit about term life insurance. Liz, ask your question.
So MK, this is regarding insurance and life insurance. So
Right.
I have mortgage insurance, and
Correct.
somebody recommended that I cancel the mortgage insurance and then I get like additional life insurance, which is term. Because the thing about mortgage insurance is that when that mortgage is done or you switch to another bank, you lose that money that you paid. So he recommended that, like, let's just say you need like $1 million to cover your mortgages if you die. He said it's better to get that in the term instead of paying the extra insurance on your mortgage. What do you think?
Yeah, so I would say that is a good advice. I mean, I don't have mortgage insurance on the properties that I have. The reason why I bought term life, again, as I mentioned here, is for where is it? See, yeah, mortgage protection. So term life is for mortgage protection. If something happens to you, yes, the term life can be used to pay off the mortgage. Now, the thing is with the mortgage insurance, usually, if something happens to you, like, okay, let's say, for example, your mortgage is 100,000, right? And let's say it's the 10-year mortgage. And let's say you pass away on the ninth year. So that means you have already paid, like, let's say 90%, right? And you pass away on the ninth year, and let's say there's only 10,000 left. So the bank will only cover, or the mortgage insurance will only cover 10,000, not the full mortgage that you already paid, right? So basically, the reason why mortgage, well, again, everybody's situation is different, but mortgage insurance, because right now you're paying a mortgage, so it's decreasing. So whenever you pass away, they will only pay the amount that is left, not the full mortgage amount. So that's why it's better to get a term life, for example, because the term, let's say your term life, let's use the same example. Your mortgage is 100,000. It's a 10-year mortgage. You have a term life insurance that is also 100,000. Let's say you pass away on the ninth year, the life insurance will pay the full amount, the 100,000 to you, whereas the mortgage insurance would only pay the remaining mortgage, and your family wouldn't get anything. So with the example of the term life, on the ninth year, you have 100,000, right? You pass away, your family gets 100,000. They can use 10,000 to pay the remainder of the mortgage, and then they can keep the remaining 90,000 for themselves. I hope that answers your question.
Thank you, MK. It does. So I'm gonna cancel all the mortgage insurance and get more term life insurance.
Yes. Okay. Any other questions regarding insurances before we jump into estate planning?
Yes, quick question. Why why do you prefer term over universal? I didn't get that piece.
Oh, okay, yes, okay. We can revisit that. So term life is more affordable. Again, the example that I used was myself. Term life is more affordable, and also it separates life insurance and investing. The other two, they kind of merge investing and life insurance. I'll give you another example. I have a friend who has a universal life insurance. His coverage is 100,000, and he said that he pays $110 per year. Sorry, $110 per month. And that he said that if he lives past, I think at the age of 60, I'm not familiar with, again, because I'm not interested in whole life and universal life, I'm not very familiar with how they work, but he was telling me that if he reaches the age of 65, the insurance company will give him 50,000. Now, and then I showed him the compound interest calculator. So he is paying 110 per year. I think he's 40 as well. So let's say he has 25 years left, and he pays 110
Sorry, was it 110 per month, right?
per month. Yeah. So the insurance company told him that when he turns 65, they will give him 50,000. So I told him, well, what if you take that 110 and you put it in the stock market and you invest it for the next 25 years? Because the insurance company, they will be doing the same thing. So the insurance company will give him 50,000 and then they will pocket the rest. So I'm like, why don't you do it so that you get the 447,000? Right. So that's why I don't like to mix life insurance and investing. Now the thing is, some people, you might not know how to invest, which is fine. So then you can go with the whole life or universal life, and the insurance company can invest for you, right? And then at the end of your life, or when you reach 65, they will give you a portion of what you would have gotten if you had invested yourself. So that is basically, now again, I'm a little biased because I prefer term life compared to the other two. But to answer your question, I would recommend you to sit down with an insurance broker, and they can basically give you all of the details. If you don't have anyone, I can recommend someone to you. I hope that answers your question, Nathan.
All right, thanks a lot, bro. I appreciate it.
Okay.
Excellent. I got something to say. So the reason I enjoy finance, I was in finance for 10 years. That's why I'm talking so much. So I do apologize, but I think
No, that's fine.
This is a good environment
Actually, yes.
for us to be able to interact, and he seems like he knows what he's talking about. So thank you, MK. It seems like you have knowledge and you're providing us with guidance, and we all work hard for our money, so you might as well figure out how to keep it. When it comes to, you mentioned sitting down with an insurance agent, we do have to be careful because insurance agents sell insurance. So you have to sit down with someone that's going to look at your whole financial program.
Correct.
And include, like you mentioned, the baby steps, getting out of debt, planning for emergency, and insurance is part of that program. So don't get caught up in, I'm going to have an insurance guy teach me which insurance to take. He's gonna give you whatever makes him the most money.
Yes, so and also to add to that, they get commission, or they get more commission when they sell whole life and universal life.
Exactly.
So you keep that in mind when you sit down with an insurance broker.
And they don't make much of investments.
Yes, and they don't make much from term life either. They don't make much from term life. So they usually don't encourage term life. They usually encourage whole life or universal life. Okay. So estate planning, which is again the third element of the wealth cycle. And again, to me, this is the easiest of all three. Again, the first cycle is, or first step is creating wealth. Second step is preserving wealth. And then the third step is wealth transfer, which is the estate planning portion. So let's take a look. Now, it doesn't start when you die. It starts when you're alive, and it starts with documents that we will get into. But so what happens on your final day? Like, what are some of the items we need to look at? So when you pass away, one of the first costs that comes to mind is the funeral cost and maybe arrangements. And, I always tell people that if you're an adult over the age of 18, you are responsible for your own funeral cost. Some people don't know this, but they think their loved ones are responsible for their funeral cost, which is not true. The day you turn 18, I think we can say that your first debt as an adult is your funeral cost. The day you turn 18, you are responsible for your own funeral cost. Whether nobody will tell you this, like your parents will not tell you, your spouse will not tell you. I mean, obviously, because they don't want you to die. But you don't, it's not, you don't, I'm not telling you this because, I want you to die. It's going to happen. It's inevitable, right? So it's good to have this information. So, but the day you turn 18, basically your funeral cost is technically your first death. And in Canada, the average, like if you want to, as the Nigerians say, a befitting burial, with a plot of land and a grave and things like that. In Canada, you're looking at 15 to 20,000, right? So if you don't plan for this, you're basically putting this liability on your loved ones. Now, the lowest cost of a funeral arrangement is the cremation. Cremation is usually quickly, I think, $800, but with taxes and everything, you're looking at maybe 1,200 or 1,800. But if you want a befitting burial, you're looking at 15 to 20,000. So the day you turn 18, you are responsible for that cost, right? So you need to plan for it. Now, if you don't have the money when you're 18, the easiest way to get it is to purchase term life insurance. My insurance broker, she told her daughter, who turned 18, to buy a term life insurance for 40 years, 250,000 coverage, so that if something happens to the daughter, her funeral costs will be covered. But also, she has insurance now for the next 40 years that has coverage of 250,000. Right now, as she grows and as she gets more educated, she can add to it. But at least she's taking responsibility into her own hands, right? So again, on the final day, when you pass away, funeral cost is your responsibility. In our communities, the Ghanaian community nowadays, it has become kind of a tradition that when somebody passes away, the next day there is a GoFundMe campaign going on for that particular individual. There's nothing wrong with it. There's nothing wrong with it. But it shows that there is a lack of perhaps preparation, and that something needs to be done, because I don't think every community does this. I mean, if it's a tragic death like George Floyd, I understand. But when it's a regular death, I think the individual should be able to cover their funeral cost. I think the website wasn't created for funeral campaigns, but that's just my opinion. If I may share something with you quickly, the Cameroonian community in Canada, they have a solution regarding the funeral preparation. They've come together and they have come to a conclusion, or they have come to a decision that if somebody among their community passes away, the community comes together and raises funds for the family of the individual, and they've came to a solution of raising 15,000. Now, once the family receives that money, they can either, I guess, bury the person in Canada, or that money should be sufficient enough to take the body back home to Canada. So this here, it says, welcome to the network, Retour au pays natal. So this simply means return to the motherland. So the initial objective of this particular mission was that if somebody, a Cameroonian in Canada, passes away, the family members will get the body ready and send the body to Cameroon. And the fixed amount was 15,000. So how did they raise the 15,000 for the family of the individual that passed away? So they came together as a community. So the community has about 71,000 members. Brian, if you remember, the last time I had this presentation, if you remember, the number which was last month.
69.
It was 69,000, right? So as you can see, their membership are growing. The members are growing, and you see the so basically what happens is there's 71,000 members. So to raise the 15,000, each member pays only 21 cents to raise the 15,000. So again, last month I did a similar presentation that Brian attended. This number was 69,000, and I think it was 25 cents. So the more people that join, the individual, um, um, I guess, allocation reduces. So we are trying to bring this to the Ghanaian community that perhaps we can also set up something like this for our own community, where if someone passes away, we come as a community and we raise the required funds so that we can reduce the amount of GoFundMe campaign pages that are being thrown around. Now, how are the funds raised? So basically, to become a member, you have to belong to an association. Now, association can be anything. It could be church. It could be a community. So as long as you belong to an association, because when somebody passes away, the leaders, they don't just go to all the 71,000 people. They just go to the individual association. So in this case, if someone passes away, they will just go to the 457 associations and collect the funds. And also, when you come to the website, you can track how many people are dying, and usually they have a brief page on the individuals. So Rebecca passed away September 11th. She was in Ajax, Ontario, and a little brief description. Pius passed away September 1st. He lived in Calgary, right? So it goes on and on. So everything is transparent. So this is something that, again, we are trying to push and see if the community can come together so that we can establish something like this for the Ghanaian community. So if you know elders in the community or anyone that is interested in having this for the community, let's get the conversation going so that we can also establish something like this for our community. And again, the Ghanaian community in Canada is much larger than the Cameroonian community. So I think maybe for us, we would be paying maybe 5 cents. So estate planning. So estate planning involves a number of documents. One of these documents is the power of attorney. So the power of attorney is basically while you are still alive. Now there are two types of powers of attorney. There is power of attorney for healthcare, and there's power of attorney for property. So the power of attorney for healthcare is a document that basically you appoint an individual to be your power of attorney for healthcare. And when you become incapacitated, this person will basically make all the healthcare decisions on your behalf. And power of attorney for property, this individual will basically manage your property or your assets when you become incapacitated. Now, you can always appoint one person to be both, or you can appoint two individuals to be one and the other, and they can work together to take care of you when you become incapacitated. The thing is, nobody knows when you become incapacitated. Even you yourself, you don't know. So it's always good to have these documents prepared so that because, you can just, be hit by a bus or, something falls on your head. And just like that, you can become a vegetable, right? So it's always good to have a power of attorney document. Usually the power of attorney document is prepared at the same time as you're preparing your will. And again, is for the power of attorney document is for when you become incapacitated. Now, let's say you are elderly, you can always activate it before you officially become incapacitated. Maybe if you need help, maybe you're elderly and you have a hard time walking, you can appoint your daughter or someone younger to basically help you with day-to-day activities, maybe paying your bills, things like that, because you can't walk or things like that. So it's usually recommended that let's say when you get older, right? Let's say in your 70s, 80s, and you feel like, you're slowing down, your memory is not as it used to be, it's usually recommended to activate the power of attorney before you become fully incapacitated. And the thing is, nobody really knows when you become incapacitated, but as you can, you have to be aware of yourself so that you can activate it properly so that you can work with the powers of attorney, and then eventually they would take over fully. Now, when you die, the power of attorney ceases to exist. So the day you die, the power of attorney ceases to exist. The document doesn't exist anymore. It's invalid. The person that is the power of attorney ceases to exist. So the day you die, the power of attorney, they cannot act on your behalf any longer. So then who comes into effect? So the executor in your will, he is the person that basically takes over once you pass away. So a will is basically comes into effect after you've passed away. And the purpose of the will is simply, the will is a legal document that gives direction on how your assets are to be distributed upon your death. It's private. A will is private until it is probated. Once it's probated, then it becomes a public document. Like I have a will right now. I have, this is my second will. I wrote my first will when I was 31. When I purchased my first property at 31. I wrote my first will. I was single, so it was just for me. And I did my second one when I got married, 35. So I'm on my second one. So right now you don't know what is in that will, but if I pass away and the will gets probated, you can go to the courts of Ontario and you can ask for MK's will and you can read everything that is in it.
MK.
Yes.
In regards to the will,
correct.
Or maybe you're going to speak about that now. But in regards to life insurance,
yes.
From my understanding, you're not supposed to include the life insurance within your will because then it goes through the same probate process. Whereas if you don't include it, they keep it separate and it runs a lot more smoothly.
Oh yes. So yes. Now, yes. So I think that's a really good point. Now, so the life insurance, you can name anybody or any entity as the beneficiary. So entity, I mean, you can name your estate. Now, so to answer your question, I will give you an example, okay? So yes, if you name beneficiaries as if you name your family or your whoever it may be, if you name your family, your loved ones as the beneficiaries of your life insurance, the money will go to them directly, tax-free. All your family have to do is just provide a death certificate to the insurance company and they will pay them the insurance coverage tax-free, right? Now, if you want to perhaps create a trust, right? And I will get to this later. If you want to create a trust, like for example, I have a friend, he said he would like to create a trust for his children. Or, I mean, it doesn't even have to be my friend, but I'll just give you a simple example. Let's say you have children and you know one of your child is a spendthrift. She spends money like crazy. And you have a huge life insurance. Are you comfortable in naming her as a beneficiary, or would you rather put that life insurance proceeds into a trust and then tell your trustee that, oh, every month pay her $1,000 or $200? So it depends on how you it depends on your family circumstances, first of all, and also it depends on how you would like to structure your estate after you've passed away. So to answer your question, yes, if you name your beneficiaries, if you name your family members or whoever as a beneficiary directly on the life insurance, you avoid the probate process and they get the money tax-free. But depending on the dynamics of your family, it could be advantageous to put the life insurance to your estate so that it passes through the will. And maybe if it passes through the will, a trust is created there for the benefit of whoever it may be. Also, if let's say you have a daughter and she marries someone you don't agree with, right? Would you want all of that life insurance proceeds to go directly to her, or would you rather channel it into a trust, which is created through your will? And then, because let's say you give her the money, you pay her outright. Once it gets into her name, since she's married, then it becomes the family assets, right? Whereas if you put it into a trust and she is the beneficiary of the trust, the husband is not part of the husband is not included. So again, it depends on your family circumstance, and I'll get to the trust later on.
Excellent. I'm looking forward to that trust stuff. You did answer my question. Thank you.
I hope, yeah. So a little bit about probate. So the probate is the process of authenticating one's will through the courts. So let's say you pass away, your executor would take your will to the courts of Ontario. In this, I'm using Ontario as an example, but whichever courts across Canada, it's usually the same process, except for the French people, Quebec. But so probate is when you pass away, your executor would take your will to the courts of Ontario, and basically, the courts will have to say that they will authenticate the will and say this is truly the last and final will of such and such person. Now that process has fees attached to it. Now in Ontario, and the fees are different across the provinces. In Ontario, if your estate, the value of your estate is 50,000 or less, probate is free, right? If your estate is higher than 50,000, probate is 1.5%. Now, if your estate is $1 million, 1.5% is 15,000. So the reason why people usually avoid probate is not really because of the amount. It's because of the third point here. When you probate a will, it becomes a public document. So it's no longer private. So anybody can go to the courts and they can ask for anybody's will and read it. So this is mostly the reason why people try to avoid probate. Now, there are ways to avoid probate. And again, everybody's family circumstances and dynamics are different. So you would have to basically review your family dynamics and see if avoiding probate is better for you. So to avoid probate is very simple. If you're married, have joint accounts, or you can have joint accounts with your children. Have a named beneficiaries on your registered accounts, or create an inter vivos trust. So this is what Epstein did before he died. He created an inter vivos trust. He put all his assets into the trust. Basically, he did that so that nobody would know what happens to his estate, because once it's in a trust, it's private. So that's a little bit about probate. Now, go ahead.
Just a quick question. So, is there any difference between the beneficiary and the successor when it comes to probate?
Sorry, can you repeat your question? I didn't hear.
Okay, sure. Is there any difference between beneficiaries and the successor, like an annuitant successor, when it comes to probate?
Sorry, I don't. Your phone. I don't know. I can't. I don't know.
Can you hear me now?
Yes, it's
Okay,
much better now. Yeah.
Perfect. No, I was just wondering, is there any difference between a successor and a beneficiary when it comes to probate, or when it comes to estates, like and taxes?
Yes, that's a very good question. So only a spouse can be a successor, and successor applies to registered accounts. Like a TFSA, your spouse can be your successor. What that means is that you know how a TFSA has a limited contribution room, same with RRSPs. What that means is that when you pass away, you can transfer it directly to your successor, which would be your spouse, without any tax implications. Your daughter or your friends, anybody else cannot be a successor. A successor can only be your spouse. And this applies to TFSAs and RRSPs. Does that answer your question, Mike? Okay. So, yes, this is a little bit about probate. So who are the actors when it comes to estate planning? So there are 3 or 4 main actors here. Again, the power of attorney, as I mentioned earlier. Again, there are 2 types of powers of attorney: power of attorney for property and power of attorney for personal care. And then we have the executor. Now, the executor, again, the executor is named in your will. And these 2, power of attorney and executor, they can be an individual or they can be an institution like a bank. Usually, like with the bank, like I was I was working for a bank, so we would be executors for individuals. Usually, I think that, well, at CD, the threshold was 750,000 in probatable assets to qualify as an individual or as a client. But you can always appoint an individual, usually your spouse, and then an alternative in case both of you die at the same time. You know, your cousin or your siblings, whoever it may be. The third actor is they're the beneficiaries. Who is going to inherit your assets, your estate? Who is going to inherit? Who are you going to transfer the funds to? Right? These are the beneficiaries. And then the 4th actor is the trustee. So the trustee is, if you create a trust, the trustee will administer the trust. Any questions regarding the actors? So these are individuals that you would have to appoint for your power of attorney, for your will, and for your trust if you create one. And then so this concept here is this is a intestacy. So what is an intestacy? An intestacy is basically when you pass away without a will. Let's say you die without completing a will. Now, each province has a different scheme of distribution. In Ontario, the scheme of distribution is that if you die without a will, the first 350,000 of your estate goes to your spouse. Anything that remains is 50% to the children and 50% to the spouse. Now, let's say you don't have a spouse, everything goes to the children. Let's say you don't have a spouse, you don't have children, everything goes to your parents. Let's say you don't have spouse, you don't have children, you don't have parents, everything goes to your siblings. If you don't have spouse, children, parents, siblings, everything goes to your nieces. And basically, this will go down until you don't have any more family members. And let's say you don't have any family members, and then yes, the money will go to the government. So to avoid this, please complete a will. Simple as that. Yes. So this is an example that actually I had encountered with. Obviously, the names and figures are different. So 75-year-old individual. We will call her Mrs. Asumisi. She didn't have any estate plan. She had a stage 4 terminal cancer. She was bedridden. She was taking a lot of cancer medication, which made her, hallucinate, and she wasn't in the right state of mind. So when you're not in the right state of mind, you don't have capacity to create a will, right? So she couldn't create a will. She had over 10 million in direct investing account. So she was her career was in investment banking. So she was able to, she did good for herself. She was single, never married, and she had no children. So in this case, based on the laws of Ontario, she had siblings. So Obviously, her parents have passed away if she's 75. So her parents passed away. She never married, no children. So again, no spouse, no children, no parents. So her siblings were the ones that inherited her estate. Is that what she wanted? Who knows? Maybe she wanted to give money to some charities. Who knows? But since she didn't have an estate plan, everything went to her siblings. Did she get along with the siblings? Who knows? So yeah, so this is the importance of having an estate plan. Another example is the famous actor Heath Ledger. He was an Australian-born actor. He was born in 1971. He had a breakthrough role in Brokeback Mountain, and also he died shortly after filming the Batman movie, The Dark Knight. He earned Brokeback Mountain earned him an Academy Award nomination, and he met his girlfriend Michelle Williams on set. They had a daughter, Matilda Rose Ledger. And then unfortunately he died, I think shortly after filming, like I said, The Dark Knight. He died in 2008 at the age of 28. So as you can imagine, he had amassed a lot of money at the age of 28. And the thing is, he had a will. He had a will because, again, he had a lot of money at a young age. So he had created his will when he was unmarried and he was childless. And he willed all his possessions to his parents and siblings. Right? So this will was created before he met Michelle Williams and before he had a child. The thing is, he didn't update the will after he was married and he had the child. So basically, all his entire estate went to his parents and siblings. Now, this is a good news story because what happened was the parents and siblings, they agreed to gift the entire estate in trust for his daughter, right? So this was a good story, a happy ending story. So now the funds are in the trust for the daughter, right? So this leads to discussion on trust accounts. So what is the purpose of a trust account? So it's a product where assets or property is held for the benefit of another person with specific stipulations. So there are three elements that are required to establish a trust. We need intent, we need a trust property. So basically, what are the assets? And we also need beneficiaries. So it privatizes your estate plan. And common uses of a trust is for a disabled child, a spendthrift child, or for a spouse. But you can set up a trust for practically anything. I can give an example. You cannot name an animal or a pet as a beneficiary in your will, but you can create a trust and name your pet as the beneficiary of the trust, and the pet can benefit from the trust. So you can basically open a trust for practically anything. Some of the famous trust accounts is the Nobel Peace Prize. If you research Albert Nobel, his story, he invented the dynamite, and dynamite kills people. So he didn't want his legacy to be someone that created an invention that kills people. So what he did is that he was unmarried, no children, so he had tons of money. So he decided to create this prize that upon his death would award the person that basically brought about the most peace in the world. And nowadays, the thing is, his legacy now is based on this peace prize. Nobody remembers him for inventing dynamite. If you talk about Albert Nobel, everybody thinks about his peace prize. Nobody thinks about the damage that he did by inventing dynamite, right? So, when we talk about legacy, you can create your own legacy based on what you leave behind. Mutual funds are usually trust accounts, and most bursaries and scholarships are all trust accounts. And again, as I mentioned earlier, insurance trust is usually the easiest trust that can be set up, simply because, again, you name your estate as the beneficiary of the insurance policy, and then you create a trust inside your will, and basically that will with the stipulations you want. In case, like, the reason I'm saying this is because it takes trust. You need, again, from here, trust property. If you don't have the money, or if you don't have the property, the easiest way is to buy an insurance policy, right? Let's say $1 million, 2 million, 3 million, whatever it may be. If you don't have the 3 million or 2 million, you buy an insurance policy, and on your death, that policy, you name your estate as the beneficiary of that policy. And then basically what happens is that the funds will go to your estate. And then from there, you can design the trust that you want to establish for your estate. And then, so there are two main types of trust accounts. Intervivals versus testamentary. Intervivals means that you are still alive, and testamentary trusts are usually created inside a will. So intervivals trust is private, avoids probate process and taxes. It's a living trust. The settler, the person that creates the trust, is still alive. It's revocable, or it could be irrevocable. Revocable means that you can simply what do you call it? Call it back or change it. Whereas irrevocable means you cannot change it. So this is separate from your will. Testamentary trust is public. It passes through the probate process and pays the necessary taxes. So again, once it passes through the probate, it becomes public. Anybody can access it and read what is in there. So it occurs when the testator passes away. So basically, when the testator is a person that creates the testamentary trust. So basically, the trust becomes active when the testator passes away, and is irrevocable because the testator has passed away, so he can't change it, right? So irrevocable means it can be changed. Revocable means it can be changed. Irrevocable means you cannot change. And the testamentary trust is usually created inside a will. So Liz had a question, and then Mike.
Sorry, MK. So when you get, yeah, like, let's just say you get 500,000 insurance, life insurance term, then you add your trust as like 100%, or you add them as 50%, and then add your whoever as your beneficiaries. Can you do that, or do you recommend adding your trust 100% as the beneficiary, and then in your trust dividing it amongst your family?
Okay, that's a good question. Now the thing is, so okay, term, right? Term comes to an end at a particular term. So you may still be alive. Now, let's say you have a 30-year term. I mean, you were right. You can still name your beneficiary as your estate because you can always die within that term, right? So it's up to you. And also, you can always, when your term is over, you can always renew it. So yes, you are right. But so you have to determine, for example, let's say you outlive your term life insurance. Do you plan on renewing it? If yes, then yeah, you have the option of naming. You can, again, I don't know your life circumstances, but this is where you have to discuss with. You sit down with the lawyer and maybe your family, and yes, you can designate 50% to your estate or 50% to an individual. So it's all up to you and what you decide to do. But with term life, because there is a term and it will come to an end at a particular time, you have to decide if you plan on renewing the term or not. If you are planning on renewing it, because as soon as you don't know when you will pass away. And usually with term life insurance, like you don't want to, well, again, you don't know when you will die, but you don't want to add it in your will, because if you plan on renewing it, then yes, that's fine. But if you don't plan on renewing it, then it makes no sense to name your estate as the beneficiary. But I mean, if you're single and there is nobody that you would like to give the funds to, then yeah, name your estate as a beneficiary. But all in all, you can name your estate or individuals as beneficiary. It's all up to you. I hope that answers.
Thank you, MK.
Yes, Mike.
Quick question. For probate,
Yeah.
is there usually a time span that well estates could go through probate? Or is it a fast process, or does it take time?
Okay, that's a good point. That's a good question. Now, when I was in Toronto, and again, I left Toronto May of 2024. When we would go to the courts, it would take about, because of COVID and things like that, they were backlogged. It would take about 8 to 6 months, 6 to 8 months for probate to be completed. And usually, to complete the probate process, it's recommended to hire a lawyer. Usually, they help because they know, how to fill out the forms and they know the processes. So it's usually recommended to hire a lawyer to help you complete the probate process. At the bank, we would always use a lawyer to complete a probate process. But yeah, again, this is when I was in Toronto back in May 2024. It was 6 to 8 months to get the probate, and there was a backlog from the COVID pandemic. But under normal circumstances, it was 3 months.
Oh, okay. Thanks a lot. 'Cause I had a friend whom did probate. It took about, I think, like close to 2 years. I was like, whoa, that's crazy.
Yeah. Well, did he do it himself or did he hire a lawyer?
I wasn't sure about the particular details. I just know it took a long time. So I was like seeing if there's an average of probate time.
Yeah. Before COVID, it was 3 months. After COVID, it was 6 to 8 months. If you use a lawyer, but if you do it yourself, then I guess good luck.
Thanks a lot. I appreciate it.
Yeah. I think Grace is it Grace?
Yeah, it's
Yes.
Grace. I have a quick question.
Yes.
Let's say you have a property, and you will it to your children. Would there be tax on it after you pass?
So that's a very good question. Now, there will be tax. Okay, so when you pass away, so the tax, if there's taxes, your estate will pay for it. Now, if it's your principal residence, there won't be any taxes on your estate because it's your principal residence. So there's no taxes. Now, when you transfer it, so let's say your executor transfer it to your daughter. So your daughter will receive the property, tax free, but she will receive the property at market value, right? So let's say you bought it for 100,000, but when you pass away, the current price of the property is 500,000. So when it transfers to your daughter's name, she will receive the property, even though it's free for her. She will receive it as 500,000. Now let's say she goes and sells it the next year. Yeah, so now she would have to basically, let's say let's say she was living in another property and she said, okay, I don't need mom's property. So now it's not her principal resident. So if she sells it, then she would have to pay taxes on the capital gains. So before you designate a property to a child, it is always recommended to speak to an accountant.
Okay.
Yes. But yes, you can definitely transfer it for free, but we have to determine if it is your principal residence or not. If it is not your principal residence, then your estate will pay taxes. And then from there, your children, we have to determine their situation, because if ever they sell it, there will be capital gains.
Or if they don't sell it and they rent it out.
Oh no, then there's no taxes. But we're talking about eventually, right? Eventually.
Yeah.
So it is because at the end of the day, it will leave their name, right? So when they pass away, or their estate might pay taxes on it. Yeah, I think there's a number of questions. I think I don't know who came. I think it's
Derek.
Derek. Yeah, go ahead.
Yeah, so I wanted to ask, so the same question that she just asked, right? So if you
Yes.
have, like, for example, an investment property, I'm just asking, would it be advisable to maybe, if you in your will, to like put it in trust for your child? And what is there like the pro or con in doing so, if
Okay.
it's a
So
possibility of doing so?
yes, it's very possible to do that. Now, the issue in doing that is this. So the property has to be mortgage free, right? Because you can't put debt into a trust, because then your beneficiaries will be paying the debt. But no, the beneficiaries won't be paying the debt. But you can't really put a liability into a trust. So the property has to be, first of all, it has to be mortgage free. That's the first thing. And the second thing is that you have to have funds to support it, because a property comes with expenses, some such as property tax, utility bills, and um, repairs. So you can have the property inside a trust, but then you need money inside a trust to support the maintenance of the property. So I hope that answers.
Yes, thank you.
Yeah. I think, Mike, we're almost done. Liz?
MK, I have a question okay, so regarding the question they had, so if you were to put that property in a trust, but you also need money for it, wouldn't it be better than to put in a corporation? I know this is kind of getting more intricate, but I think I'm assuming most of the people on this call want to like have investment properties and how to pass it on to their kids and to their family to create some sort of legacy. Like, instead of, how do we move from like the personal into maybe where we can put into like corporations where it like generates more as a business for our future kids and our grandkids? I know it's
Yes.
kind of getting intricate, but
Yes, I mean you can do that anytime, but the thing is, once they transfer from your name to another entity, the necessary taxes has to be paid. All right.
yes,
So as long
yes.
as you pay the necessary taxes, then yes, you can transfer it to a trust or you can transfer it to a corporation. But again, if you do that, you need funds to support the property, because yeah, it can just be sitting there in a trust, but if there's no money to support it, then who's going to maintain it? Because your trustee would need funds to pay the property, because property taxes, it doesn't matter if if the property is mortgage free, the province needs the property tax or the municipality needs the property tax. If I can just wrap up quickly. So the way to get started is to quit talking and begin doing. So basically, Walt Disney, this can apply to estate planning. It's really important to, get started as soon as possible, especially with all of the items we mentioned in terms of investing, in terms of insurance. The earlier you get these things done, I mean, as we saw with compound interest, the earlier the better. Life insurance, the earlier the better, because of health risk. You don't want to get any adverse health, diseases, as you age. So the earlier you get these things done, the better. So if we can read a little bit of scripture, it says Proverbs 13:22, a good man leaves an inheritance to his children's children. So we don't want to plan for Saturday. We want to plan for 3-7 generations from now, right? So that's something to keep in mind, right? Plan for 3 generations and not just for Saturday night. So I don't know if there's any other questions, but we can tackle some more questions. Otherwise, here are my details. You can reach me by email. I have Instagram as well. I mean, social media is all MK Bonsu. So LinkedIn, Facebook, Instagram, whatever it may be. email is mkbonsu@gmail.com. And I currently live in the Cayman Islands. So the phone number is 345-924-8950. You can reach me on WhatsApp. I still have my Toronto number, but I don't turn it on. I don't want to roam. I roam when I go to Toronto. Yeah, but thank you guys very much. It's been great. Some really good questions. Yeah, Brian, if you want to have any additional notes.
Oh, I just want to thank you greatly, greatly, greatly. If we can all give it up for MK Bonsu. You did an amazing job of sharing insights with knowledge, and you're greatly appreciated. And, you know, we would love to have you come back another time.
Yes, not a problem.
And I just want to let everybody know that MK also does one-on-one personal finance coaching or consultations at his company, Common Love. So feel free to reach out to him, get in touch with him. And if you want to book a session, he can deal with you on that level. So thank you once again. Appreciate you. Much love to everybody for showing up, everybody who stayed with us throughout the duration. It's been very insightful, and I'm thankful.